There's so much talk out there about the Bank of Canada rate, but do you understand how it's actually tied to the variable rate mortgages and to fixed rate mortgages? In this video, we're going to break it down. The Bank of Canada rate, or the overnight lending rate, is the starting point for all interest rates in Canada. I don't think people know this, but it's the rate at which banks lend money to each other overnight to balance their books. When the Bank of Canada raises this rate, it becomes more expensive for banks to borrow, and they pass those costs on to you. That's why your mortgage, credit card, and loan rates can all go up or down depending on what the Bank of Canada does. The Bank of Canada rate is not the same as the bank's prime rate. Prime rate's another term that you see flown around. After the Bank of Canada sets its rates, the banks take that number and add a buffer to it, usually about 2.2%. This number then becomes the bank's prime rate, which they usually offer to their best customers. So if the Bank of Canada rate is 2.75%, the bank's prime rate will be around 4.95%. And the prime rate is the number that most variable mortgages and lines of credits are tied to. In the next video, I'll show you how your mortgages get tied to prime, so be sure to watch it. And as always, please like, share, and follow Team Bracken Realty for more real estate.